Hi everyone, I recently got together with Evelyn Clark at EverLend in Melbourne. So Evelyn has a podcast she started in late 2022 called You Have My Interest. And we wanted to deep dive into the topic of commercial lending and also working capital within a business, and ultimately what a healthy cash flow cycle looks like and how to implement specific debt facilities into businesses to look to make them more efficient and driving stronger margins and profitability. So Evelyn is an absolutely wonderful broker, and I'm really excited that we got to do this together. So let's get into it. If you have any questions, please feel free to leave me a comment in the notes, but enjoy.
Hey Jack, how are you going?
Good. How are you?
I'm good, thank you. Thank you so much for coming on the podcast today.
Thanks for having me. It's been a while in the making.
Yeah, I know. I'm excited to talk to you today because we're going to dive into commercial lending, but more specifically working capital, which I know is your absolute specialty in your business.
For sure.
Before we do jump into that, I would love to just get to hear a little bit about your business, why you started it up and what drew you to the business side, because we both do a little bit of resi, but I know that business is definitely your strong suit. So tell me a bit about how that came about.
Yeah, for sure. So I worked in Bank of Melbourne and Westpac Group for probably about 5 years-ish, and then stepped over to Liberty to help them set up an unsecured commercial division. And out of all of that, that was about 7 years all up. And then after that, I said, I'll go and give it a crack under my own banner. So to answer your question on how it got that way was... I was a commercial banker back then, so that's sort of the skills that I developed. And aside from that, I was in a pretty niche part of the bank, which was the ability to borrow without security.
Yeah.
And when I say without security, I should be more specific and say without tangible security, so maybe a commercial property or a resi property. And I didn't really recognise at that point, because I was really early in my career, that that's quite an unusual sort of spot that even a lot of bankers even don't get exposed to that. And from a broker perspective, I would say maybe only 20%, if that, would do this sort of lending. And it made sense to kind of try and niche down a bit and go for that. Yeah,
awesome. So in terms of, I guess, identifying between secured versus unsecured in the way that we know it as brokers, so obviously not traditional security or, property-backed security. Can you give a bit of an overview of the differences and how, I guess, what sort of clients may gravitate towards one or the other in terms of what they need?
Yeah, absolutely. So traditionally a client will come to us and they don't know much more other than what the need is, which is, I need some money generally. And then we will need to work backwards from there on what they're looking for. So traditionally, there are pros and cons to secured and unsecured. Secured is obviously much cheaper because it's de-risked for the lender. So you're looking at traditional sort of rates, which is kind of, if you're in a major bank, sort of like the 6s, 7s is kind of where you sit. Whereas if you don't have the ability or the luxury to be able to throw up a security, which potentially some small business owners either won't be able to or won't want to, at which point we'll need to look at unsecured options. And there's a couple of differences there, which is it's more expensive, obviously. The loan terms are generally much shorter, so you can go up to, say, like 20, 30 years or whatever on a fully secured loan, whereas unsecured, depending on your lender, potentially maybe 5 years max, maybe 10 is kind of where you're sitting. Yeah. And also, as I said, a bit more expensive as well. So the answer is, it's kind of how long's a piece of string in terms of the best option for a client. And traditionally, we're trying to build a facility around the needs of the client that it's going to really tick the boxes of what they're trying to do.
Yeah, for sure. So I guess if we look more traditionally at commercial lending that is asset-backed, I mean, there's so many purposes in lending, right? People can be purchasing a site, they can be purchasing a business, they can be needing to cash out for something. What are the traditional or the most typical types of funding that you're generally seeing in the unsecured space?
In the unsecured space, that's a really good question. So just with where the market is at the minute, it's a very different market to what it was 2 years ago, for example. 2 years ago, interest rates were low, the market was awash with cash, the government was pumping it in, It was very much an expansionary market where people are not looking to borrow to fix problems. They are looking to borrow to grow, which is, investing in the business. We might be looking at paying some wages to someone who's not going to be able to, for example, generate any revenue for 3 to 6 months. That's going to create a cash flow drag, obviously. So that's potentially something that we looked at back then. People would also be looking to buy other businesses, for example, or that sort of more growth stuff.
Yeah.
It's a bit of a different market now, I would say, for particularly SME type guys who are now in more of a restructure type mode. So they've gone through a lot of growth, interest rates have come up, and now they're looking to restructure these loans such that they may need to fix some problems, which is probably more common these days, which is they may have cash flow gaps, for example, or they've got some issue that they need to fix with cash, at which point we need to use an unsecured facility to be able to enable that debt. But yeah, it just depends.
Yeah, for sure. So can you define for me commercial lending?
Yeah, so it's something that brokers really do tend to kind of just umbrella, and there's so many aspects. It's not like home lending where just home lending is home lending. There's so many different aspects, which is why we need to define it. Commercial lending can be broken down into a few things, which is the person borrowing to buy a commercial property, which is kind of pretty similar to buying a house, but it's a commercial property, so the process is quite similar. Then there's, for example, working capital or working like cash flow type facilities, and that can be a term debt facility, for example, which is just like pumping a little bit of cash in, which will amortize to zero over time. Or you've got like an overdraft, for example, revolving facilities, which again, they are your true working capital type facilities.
Yeah.
And then you have these, for example, invoice discounting, which is the ability to close your cash flow gap, for example, if you're a business that operates with a lot of stock and, these potentially, if you're buying the stock, it's waiting to be delivered, then you sit on it for 10 days, then you sell it, and then you get paid 30 days later, for example, that creates a huge gap in the market, in your cash flow, cycle, I should say. At which point, if you can consolidate that 50, 60 days into 10 days, you can get much more capital into the business. You can buy more stock, which means you could sell more stock and make more money. So
yeah, for sure.
There's a lot of different aspects of what is commercial, I guess.
Yeah, for sure. I remember when I was starting out as a broker, I started working with a broker who had left commercial banking as well. And we kind of jumped straight into like invoice financing. And for me, I'm like, hang on, I don't even know what a home loan is, let alone we're jumping into probably one of the more complex commercial lending arrangements, I guess, from a traditional perspective.
Yeah.
So it kind of opened my eyes up to just the scope of the different types of lending when you do get into the commercial realm. Yeah, pretty amazing.
And the other bit of it is, you speak to the people who are very much like, debt adverse, or they've grown up with parents that have gone, don't do debt sucks, blah, blah, blah.
Yeah.
Definitely relevant to some people who potentially use, credit cards to buy Gucci handbags or whatever. It's probably good advice to not do that.
Probably.
But for example, there is definitely an opportunity cost as to not using it if it is for a working capital type lend. For example, what you've just mentioned, which is, invoice discounting. If you have the ability to close your cash flow gap such that you've got more cash to buy more stock and therefore more stock to sell, and then more sales obviously creates more money, the opportunity cost is not doing that and selling less stuff and then obviously profiting less. So if utilised correctly, well-structured debt can be great.
Yeah, for sure.
Just something to say on that as well, which is the value of a good broker is if you look to put in, say, working capital facilities, for example, and they're not well structured and they are, you're given advice, which is to use facilities that are not the best they can be, what ends up happening is they're poorly structured, you're not utilising the security correctly. If the security is not right, it's inefficient. If it's inefficient, you're going to have a higher rate. If you have a higher rate, it's going to cost you more money. So that's the cost of using a broker that doesn't specialise in this sort of stuff.
Yeah.
You want to be using a broker that is specialist in working capital facilities if that's what you're looking for. It's not like going and getting a home loan where one size fits all. You really
For sure. Out of all the commercial lending facilities, I guess, that you've mentioned, your niche is the working capital. Do you do other commercial lending, or is it really just honed in on that?
What we specialise in is self-employed,
Yeah.
and the reason for that is, as you will know in your own business, which is they're not cookie cutter, they're not one size fits all. If you are self-employed, you've been through the process of getting debt with someone that doesn't specialise in self-employed or doesn't quite totally grasp self-employed and do more PAYG sort of stuff, you will have a problem, and a self-employed person knows that.
Yeah.
I don't need to tell them.
Yeah.
At which point it's an easy sell for those guys because they know that they're more complex.
Yeah.
We look at it from a holistic perspective, which is we don't want to just, they will usually come to us with a single objective, which is I want money to do this.
Yeah.
And then we go, cool, let's just zoom out a bit and have a look at the total, like your whole aspect here, because for some deals we may need to throw in a house, for example. The house might be somewhere else. We might be able to pull that in and then potentially over leverage to up to 100% or 110% of the value of the property.
Yeah.
At which point then we can structure all of the facilities together such that it's the most cost effective and efficient for that customer.
Yeah.
That's why the specialty is self-employed, so we can do the whole lot. And because if we do everything together rather than just little bits and pieces, it's much easier to deliver an outcome where we take everything and it's much cheaper and more, I guess, it's better structured for the customer.
Yeah, for sure. So by having, I guess, those additional securities where needed with the bank, they can provide, as you said, better pricing potentially, but also you can kind of over leverage. So where in traditional, if we look at resi lending as a comparison,
Sure.
typically you're leveraging up to 80% or more if you're going to be paying lender's mortgage insurance, or there's a reason that you can get that sort of additional percentage. But you're not really going above 100% unless it's a guarantor loan, in which case the purpose is not to refinance above 100%, it's to buy the asset itself. Whereas in the commercial space, what you're saying is you can potentially take an existing security that they already own, leverage above 100% of the value of that for potential business needs as well.
Exactly, spot on. So a home loan, by definition, under the NCCP, they will only let you go to 80% or over if you've got the LMI, which means even if the bank wants to take the risk, they're not allowed to under the regulations. So the way it operates is obviously a commercial loan is not governed by consumer protections, such that the bank will say, cool, so we'll let you go to 80% on the resi facility, which is obviously looked after by consumer protection. But the commercial loan, which is not consumer protected, we can go, they're not mandated by law to stick at 80, for example. They can go to 150 if they wanted to, but it's just then it becomes a matter of credit risk and that sort of stuff. Whereas on the resi facility to 80%, that's actually like mandated by the law, plus LMI, obviously to keep, the system safe and keep our housing market secure.
Yeah, for sure. Fantastic. So let's jump into a little bit about cash flow. And we will touch on some of the working cap facilities as well. In terms of your opinion, you've seen a lot of businesses, you've been in commercial banking. Why is cash flow so important in business? Why are the issues for cash flow something that can kind of make or break a business, and how can you support that?
So any small business owner will say my biggest issue is cash flow. And cash flow will hamstring even a business, which is, if you're, for example, dealing with stock in a business, you need to buy the stock, you need to get it into the business, you need to sell it, and you need to get paid for it. And the gap that happens between all of that is money that's not within the business. It's tied up in the cycle, which means that's money that you can't use for wage, for example, or to buy new stock and that's the biggest issue that customers have, because they do have the cash there. It's just stuck in that cycle of buying and selling stock. And they will say that that's the biggest issue. So I think it was Judo. They did a report on the biggest issue that they had, and they said it was cash flow. And ties nicely into the Judo mantra, which is they do business lending, obviously. But from an opportunity perspective for the banks, they obviously do cash flow lending, but it's not as easy as it should be. It's not like a home loan where you just say, I want one and you can have one. It takes to get the actual the policies and the products to work, you need to have a decent broker that works in that sort of lending, I would say, and they need to have the contacts within the bank to be able to write those sort of products, because again, it's a specialised space. Even if you're a banker, if you went to a home loan banker and said, I need commercial facilities, they'll be like, I don't know how to do that.
Yeah.
Exactly. So yeah.
Yeah, okay. So what sort of working capital facilities do lenders offer?
So they, broadly speaking, will break it down into secured and unsecured facilities, and the one that we're going to use is going to come down to ultimately what the client is prepared or able to provide. So, for example, if a customer's got a house that's, say, leveraged at, say, 65 or 70%, it would probably, depending on the purpose of the funds, make sense for us to take money out of the property in a commercial loan.
Mm-hmm.
And the purpose for that, or the reason why that's important, or we would do it that way, is because there's security underneath it, the bank is more inclined to give us a longer term.
Yep.
A longer term means that the customer is going to be repaying less monthly, which
Yep.
means we're going to have less stress on the cash flow of the business.
Mm-hmm.
Compare that, for example, to an unsecured facility whereby the max term, if you are speaking to potentially a Prosper or someone of that nature, they will tend to term these at 2 years, which means unless you've got a pretty defined way of getting out of that loan, the repayments are going to be pretty significant on something like that. And that probably leads me into the next bit that I think we should talk about here, which is the use of using unsecured lenders, which is they're not for everyone.
Yeah.
Even though you may be able to get the money from them, it may not be the best thing for your business. Now, the quantification on that, or how that works is, if you've got a business, for example, that there's a problem that a business can have, and they look kind of the same, but you need to understand which one's which. A business that is having cash flow problems, an unsecured facility can work for. Cash flow problems means the gap between putting money out and receiving money back. That's the cash flow gap. A business that is just not selling enough product and therefore not making enough money, for example, and can't meet its commitments because it doesn't have enough profit, because it's not doing enough as a business, that is an example of a business that probably doesn't need unsecured debt. What that really will do is it's going to perpetuate their issues, which is you go, this might fix your problems for 3 months. Then the reality is, because you're not making enough money, there's not enough money coming in the top, you're effectively going to be in the same place you're in right now 3 months later, except now you've got this other bill you've got to pay as well, which is the unsecured lender. And that can create massive problems, obviously. So that's why I'd say on products like this, it's really important to get advice, because cash flow problems versus profitability problems, they look the same to a small business, but obviously they're not. I'll give you an example on what a cash flow gap looks like. If I've got a customer who goes, I've got the ability to buy stock, and I need to buy $50,000 worth of stock, but I have to pay for it day one. And I can't get it unless I pay for it day one, and then I get it at, say, day 15, and then I can sell that 50K worth of stock for 100K and pay the debt back on the 30th day. That is a good example of where this will work, because that is purely you're just funding the cash flow and you've got an exit plan on how to get the money back in. Whereas the guy that says, I just need $20,000 because I've got obligations that I've got to pay, the lease and the wife's Beamer and blah, blah, or whatever it is, or the guy's Beamer, whatever. That's probably an example of where we need to look at restructuring your existing debts potentially. I mean, you may have 3 facilities out there that are unsecured that are biting at 25 or 30%. They're all on 2-year terms. That's going to create a massive, massive cash flow problem. If we can refi those, for example, into a property or a fully secured facility, we extend those from 2 years to 30 years, no cash flow problems, happy days.
Yeah, that makes sense. How do the banks look at these unsecured lenders? I know, the likes of Prosper came out relatively recently in terms of the lending landscape. And when they initially came out, there was potentially a little bit of I guess, negativity looked upon them when a lender might have been assessing their business position and realising that, because I think originally when these lenders came out, it was looked at a client having cash flow problems that they needed it. So how do they look at it now? Has that changed?
Yeah, it's a really good question. What happens is your unsecured guys like Prosper, for example, have the ability to lend where banks can't. And the way they do that is they don't assess them on profitability, which is the P&L and the balance sheet.
Yeah.
They will assess them on how much money is going through the business account. So it's a little bit different. That means that Prosper, for example, can lend where the banks can't.
Yeah.
Now, that has advantages and disadvantages, but to answer your question, the disadvantage is a bank can look at this and go, these guys have got cash flow problems, when that's not actually the reality. They just, for example, may have a P&L that doesn't demonstrate that they can lend. And that might be because whether or not this is the right thing or the wrong thing to do, they might have, I'm not going to say minimised tax, but optimised their tax position, at which point, you know, they're not bankable. So the answer is it depends, I suppose, which is, yeah, it depends on the story. Like I've got a client right now who we're refining about $400K worth of that unsecured sort of stuff. They're all running at about 30%.
Yeah.
He's just in a business that is absolutely booming. It did maybe like 200K last year and is now going to do about 3 million this year.
Yeah.
And that's just because he's just in such heavy growth mode. And, you know, they're not commercial bankers, these guys. They just see an ad for money and they go, I need money. And then off they go. That's an example of someone who they've just grabbed those facilities because they were quick and easy and they're there. And now we're transitioning into a space where we go, let's get you a little bit more of a long-term facility. Let's try and restructure everything such that we can talk about the next 10 years rather than the next 6 months type thing.
Yeah, for sure. And I guess the good thing for them is they leverage that facility for the growth. So now they're in a good position. They can refi out, maybe look at a more bankable product as opposed to a smaller cash flow unsecured lender.
Exactly.
Yeah.
And also like those unsecured lenders, they tend to charge a lot more than the majors. And I'm not saying that's a bad thing. That's just the nature of their business, which is they are prepared to do more high-risk stuff. They're not taking security is the first thing. They'll run on a 6-month ABN. Bank won't do it at 6 months. They'll run without P&Ls and balance sheets. Banks won't do that. So the nature is they are more expensive, and that's okay. But, you know, it's just when we get to the point that they become bankable, we should probably be trying to transition them out of those facilities into more long-term, you know, facilities with a banker and a substantial, you know, Big Four bank. Yeah,
for sure. And you kind of touched on something there that I wanted to ask you, which was around documentation requirements. So with a major bank, I guess it's kind of how I look at from a resi perspective. I'm just putting my resi hat on here. It's kind of like looking at a full doc application versus what we call a low doc, which is obviously providing less documentation. Maybe their ABN's been registered for a shorter period of time, etc. What are the banks requiring? And my second part of that question is, if you have had a client that's had maybe a significant up growth in their revenue or their profitability or whatever it might be, but that's not yet showing up in your financials because they haven't completed that financial year, can that still be demonstrated to the bank rather than an unsecured lender? For sure. A lot to unpack there. So I'm going to go in reverse because I remember that one. Okay. So the answer is yes, absolutely. We can demonstrate growth because obviously we only do a set of financials every 12 months. And if you've got a business that's, say, 3 years old or 2 years old, not unusual for them to just be growing like that. At which point we can validate it with a couple of ways. We'll use projections, which, you know, sometimes are not worth the paper they're written on. Yep. But we can validate those projections with BAS statements, which happen every 3 months. Yep. So on the quarter, we can start to show, although they're only validating the revenue, they're not seeing the profit, it's still enough to say we are validating the money that's going through the accounts, Yeah. In terms of bankable or appetite, that's what your question was. So a full doc lender, so a bank, for example, you're very spot on in the sense that it's very similar to a home loan. It is a full doc loan. They want to know absolutely everything. They want to see 2 years of fins. They want notice of assessments, tax returns, trust deeds, returns on
the whole lot. It's the whole gamut. Now, the reality is that is difficult, but it's the price you pay if you want a well-secured and a well-structured facility, which is, if you want long-term facilities at low rates and you want a bankable deal, then you got to go through the bank hoops.
Yeah.
And that's one of the downsides of, obviously, like going through the majors. But the majors' upsides are great structure, longer terms, cheaper rates, even potentially, they'll do, for example, we did last year a 5 mil unsecured lend. That is $5 million unsecured would never exist outside of a bank.
Yeah.
Because like no private lender or no, group backed by, Credit Suisse money or whatever is going to say, we'll let $5 million go out the door with that property, regardless of how good the deal is.
Yeah.
So that sort of stuff has to go through a major and it has to be a full doc loan, that sort of stuff.
Yeah, that makes sense. So traditionally, banks can also lend more money. How much are clients capping out at if they're going through someone like...
Hi everyone, I recently got together with Evelyn Clark at EverLend in Melbourne. So Evelyn has a podcast she started in late 2022 called You Have My Interest. And we wanted to deep dive into the topic of commercial lending and also working capital within a business, and ultimately what a healthy cash flow cycle looks like and how to implement specific debt facilities into businesses to look to make them more efficient and driving stronger margins and profitability. So Evelyn is an absolutely wonderful broker, and I'm really excited that we got to do this together. So let's get into it. If you have any questions, please feel free to leave me a comment in the notes, but enjoy.
It does. Yeah, you do say that actually. So there's a few things. So are you talking secured or unsecured?
Well, both if you're...
Traditionally, we will look on annual reviews on more unsecured facilities. And when I say unsecured, I should clarify, what I mean by that is no property as security. They will still take, for example, a charge over the business. So it is secured, it just doesn't have property. They will look to take, or depending on the deal, they'll do annual reviews on that sort of stuff because the security in the transaction is the business itself. So they want to look at what the health of the business looks like, such that if the business is less healthy, obviously the value of their security is lower. So they want to look every 12 months just to make sure that the business is trending the right way.
Yeah. So if I was a client that had some sort of maybe business growth that I need assistance with from raising some capital effectively in my business to get there. So I need to borrow money to get me to where I need to be. Or I maybe have some facilities that need reviewing and they're getting a bit expensive or they're just not structured correctly. How can I put myself in the best position, other than coming to someone like yourself who is an expert in that field, but how can I actually put myself in the best position to ensure that I'm going to be able to get the right structure on my lending?
Good question. So without seeing someone like me, unless you learn how to do my job, then I'd say you can't do it, basically. It's kind of like saying, how do I diagnose this heart palpitation in my chest without going and speaking to a heart expert? Okay. Like it just kind of doesn't.
So basically the answer is just go and
just
speak
come
to
and
Jack.
see me. Pretty much. But essentially it is... the reason why it's important is because there is no one size fits all, particularly in self-employed or commercial lending. The majority of clients, for example, a butcher, for example, they don't know what facilities and structures and blah, blah, blah. Like they don't know what all of that looks like.
Yeah.
They just want to go back into their shop and make more sausages. And you go, okay. They go, they'll come to you with a goal of money, which is we want X amount of dollars to do this. Yeah. And you go, okay, cool. We need to come back a couple of steps. Tell me what you're trying to do. Tell me what your long-term strategy is. Are you looking at buying this commercial property that you're currently renting? Is that not interesting? Are you looking to transition to retirement? All of the answers to these questions are going to massively change the objective or the goals of what we're going to put in for this guy and or this girl, I should say. And the other side of that is it's different to a home loan in the sense that a home loan is set and forget, which is the purpose of a home loan is to buy a home.
Yeah.
And, it's a 30-year term and it reduces to zero. And the purpose doesn't change over time. The difference with commercial operators and self-employed operators is their goal on January of this year can be potentially totally different to what their goal is January next year. And that can be based on their clients are changing, or the market is changing, or, if the interest rate environment is different, at which point you might have gone, January this year, I might say or last year, I could say, my goal is I want to put away $200,000 to buy a boat, for example, because 2 years ago or a year ago, that was kind of a thought, which is there's so much money, life's good, we can do whatever we want. And now today, you go, that's probably not the best idea. And I want to, I need to restructure because I want to put on more people, because I want more productivity, which is going to cost more growth. And then there's going to be a cash flow gap while I get those guys trained up. So, and that's changing all the time. So we speak to them at minimum every 6 months and just say, hey, just checking in. And that is usually more than enough time for them to go, thank God you called, we're doing all these things, we need to restructure these facilities. What we said we wanted to do 12 months ago is not the reality anymore. Or we did put something in that's not working, it's too expensive, or we've got this revolving line which is costing us too much money, we need to transition that into another facility which is going to be cheaper, I want to get rid of it. There's just so many
for sure.
different bits and pieces, which is why we try to stay on top of them in terms of they're evolving, their businesses are evolving, and we need to be on that journey with them, which is, again, probably another reason why you need to come and speak to us.
So what I'm getting as well is that it's not a case of, I guess, always needing to wait until you have an immediate need, but it could just be a matter of coming and speaking to someone like yourself earlier as well and saying, look, this is a future goal that we're thinking about, as well as obviously if there are immediate needs, yes, but I guess not people leaving it too late before they are in potentially an issue that they need fixed.
A business that is in a bit of a oh shit position is the options for that client are getting tighter. It's getting harder. And if they're getting harder, that means they're probably getting more expensive too. The best way, and this is the advice I give everyone, is get a contact who's going to help you with this sort of stuff and keep them all the way through, because they're going to show you what the goalposts look like to grow. They're also going to keep you away from the sharks of saying you need to avoid this bit here. Make sure you don't land there, because then you're really going to be in big trouble. And that comes particularly with things around your credit score, for example, is what most people would think of, but also the metrics of the bank, what they need to see or not see for you to be bankable. So it's a matter of keeping yourself in this little position such that you become bankable and you stay bankable. And that's why, people who don't know what those metrics look like are not obviously going to know what they need to be doing, which is why, in my opinion, you should be, if you're self-employed, you should be speaking to someone minimum every 12 months just to go this is the plan. Do you think that's smart? If it is, what do we need to do to get there? And then you can really start to, at that point, build out what your roadmap looks like over the next 3, 4, 5 plus years.
Yeah, awesome. No, I think that's a fantastic way to finish as well, and just, I guess, let people know that it's really, really valuable to have those contacts. It's very traditional for people to go directly to a bank, but as you say, you're playing that sort of advice piece for clients as well, which is fantastic. And if they can have their hand held throughout that process and, be able to move their lending as their goalposts move as well, it's just going to support them to grow their businesses even more. So I really appreciate you coming on the show today.
Thanks so much for having me.
That's okay. How can people contact you if they have any questions, if they want to reach out in terms of business lending? For sure. Email address is jack@leveragecapital.com.au, or just give me a call. Perfect. We'll pop your details in the show notes. Sure. And people can reach out to you that way. Awesome. Thank you so much for having me. No worries. Thanks, Jack.